Okay, let's just dive right into this explainer because, wow, if you've looked at your portfolio recently and felt a serious sense of whiplash, you are absolutely not alone. Today, we're diving into a comprehensive briefing titled Operating in the Temperamental Era, and honestly, it is going to completely reframe how you look at the global economy. So, the crucial point established right off the bat by the Charles Schwab strategy team is that the old, dependable era of the past 20 years, it's officially dead. We are not going back to the way things were. The old playbook, where you could basically just buy broad index funds, kick your feet up, and watch central banks smooth out every single bump, is just gathering dust now. To survive what comes next, we have to embrace a radically different mindset centered on flexibility and factor-based investing. It's about focusing on the actual drivers of return rather than just blindly riding the broad market.
All right, Section 1, the shattered baseline, from moderation to temperamental.
To navigate what comes next, we really have to thoroughly understand the comfortable baseline we literally just lost. For the past 20 years, we lived in what economists call the Great Moderation. Think about it. Inflation was totally suppressed and highly predictable. Global logistics were absolutely seamless. You could order a part from halfway across the world and it just magically arrived right on time. Broad market indexes practically printed money. But today? Well, the temperamental era is chaotic. We are dealing with heightened, volatile inflation fueled by tariffs and wars. We're seeing geopolitical choke points and export bans replacing those seamless supply chains. It's a fundamentally different operating environment.
Moving right along, Section 2, the new mechanics, uncovering the drivers of the temperamental era.
We don't have to just guess at why things feel so broken right now. We can actually lift the hood and see exactly what is driving this new machine. Geopolitical fragility is a massive driver here. For instance, U.S.-Iran hostilities have created a severe choke point right in the energy corridor. When military strikes effectively destroy diplomatic off-ramps, the market reacts instantly. We're looking at a situation where shipping traffic in a critical global artery is operating at just 42% of its normal capacity due to tanker attack risks. That instantly spiked Brent crude past $78 a barrel, even touching $80 intraday. And when energy moves like this, the shockwave hit absolutely everything.
But hey, it's not just oil causing problems. In a completely different sector, contrary to pretty much everyone's expectations, the sheer tsunami of capital being poured into artificial intelligence is actually functioning right now as a massive new inflation engine.
The cycle here is fascinating and honestly a bit alarming. We see mega-cap tech companies injecting massive capital into AI. But right now, those promised productivity gains, the things that are supposed to make everything cheaper and faster, they just haven't created meaningful downward pressure on inflation yet. Instead, we have unprecedented infrastructure strain. The insane demand for custom silicon, massive new data centers, and the raw energy just to power them is creating localized price spikes. And that feeds right back into persistent macro inflation. The AI boom is literally keeping prices stubbornly high.
Which brings us to Section 3, the Federal Reserve's gridlock. Why the savior is stuck.
For basically the last 2 decades, your portfolio relied on the Federal Reserve to just swoop in and cut rates during a crisis. But that safety net? It's currently paralyzed. The Fed is trapped in a brutal gridlock between conflicting indicators. On one side, you have this heavy weight of upward inflation risks, elevated commodity prices, lingering supply disruptions, and that massive AI infrastructure demand we just talked about. But on the other side, a cooling labor market. Employers added only 57,000 jobs in June, with unemployment stabilizing at 4.2%. Central banks are just fundamentally ill-equipped to manage supply-driven inflation shocks through monetary policy alone. They can't exactly print more oil or manufacture custom silicon chips.
And this gridlock creates some absolutely terrifying math for traditional portfolios. For years, investors relied on a historical baseline where bonds protected you when stocks fell, but we are now seeing a massive correlation flip straight into negative territory. In the temperamental era, inflation risk is the market's focal point. So as the 10-year Treasury yield climbs, hitting highs we literally haven't seen since May 2022, stock prices fall right alongside them. Bonds just aren't providing that reliable portfolio diversification you thought you had.
Let's look at what this means in practice. Section 4, Bizarre Symptoms. Market Anomalies in the Real World.
Let's ground all this macroeconomic theory in reality by looking at 2 downright bizarre market anomalies happening right now because of these pressures. First up,
Tech is completely defying gravity. Despite global conflict and all those nasty inflation metrics we just covered, the appetite for artificial intelligence infrastructure is completely insatiable. Just look at the SK Hynix mega IPO, a $28 billion US listing that was 7 times oversubscribed. I mean, that massive demand instantly reignites the tech momentum trade. Combine that with a $30 billion onshoring deal between Apple and Broadcom to secure domestic custom chips, and you see companies basically building financial fortresses to neutralize geopolitical risks.
Second anomaly, let's talk about airlines. Historically, if you had a war plus an oil price spike, airline stocks got completely destroyed. Jet fuel is incredibly costly. But today, airlines are surviving through a fascinating new financial architecture. They are heavily relying on a K-shaped consumer. There is effectively zero seat growth in the main cabin. Instead, premium seating like business and first class now drives over 50% of revenue. Add in co-branded credit cards where consumer spending persists regardless of travel slumps, and you have airlines insulated from energy shocks in a way they literally never were before.
This brings us to Section 5, the retail revolt, demanding transparency in a volatile era.
Everyday investors are watching these wild swings and bizarre anomalies, and they are demanding to keep the few safety mechanisms they actually have left. Get this, an overwhelming 99% of over 8,080 public comments vehemently opposed a recent SEC proposal that would have reduced crucial 10Q corporate reporting down to a semi-annual basis. In a highly volatile macroeconomic environment like this, market participants view detailed, frequent disclosure as absolutely mandatory.
Everyday retail investors on forums like Wall Street Bets and advocates at Better Markets are entirely united on this issue, which is pretty amazing. Better Markets straight up called the proposal a slap in the face to investors. And as the comment from Wall Street Bets points out, institutional investors already have expert networks, direct management access, and literal satellite imagery at their disposal. For the everyday investor, the quarterly 10Q report is the single most important leveling mechanism to survive against that kind of institutional firepower.
All right, final section. Section 6, the new rulebook, surviving without a safety net. Because central banks are fundamentally ill-equipped to manage these supply-driven inflation shocks, we desperately need a new way to invest. We have to completely retire the Fed put, that long-held assumption that central banks will always rescue markets during a crisis. To operate in the temperamental era, you really must adopt these 3 principles. Number 1, accept structural inflation. It's remained above the Fed's 2% target for years now, and central banks will not rescue markets if it means sacrificing price stability. Number 2, discount the AI deflation miracle. The long-term productivity gains are absolutely real, but they aren't manifesting as a deflationary force on goods and services just yet. And number 3, acknowledge tariff permanence. Geopolitical friction and onshoring mean higher structural costs are baked into the global system permanently.
So here is your actionable playbook for the temperamental era. First, move away from passive reliance on mega-cap indexes and shift to factor-based investing. Focus on specific fundamental factors like quality, free cash flow, and margin resilience. Second, exercise immense duration flexibility. With erratic 10-year Treasury yields and those terrifying negative correlations we looked at earlier, long-term bonds carry outsized risk. You have to be nimble. Finally, demand immediate profitability. The era of zero interest rate patience is over. You must exercise extreme wariness toward companies projecting massive growth promises far into the future without the current cash flow to back it up today.
We've covered a ton of ground in this explainer today, from shifting global logistics all the way to the AI inflation engine. So, it's time to take a hard look at your own strategy with one vital question in mind as we wrap this up. The safety net is gone. Is your portfolio built for the outdated moderation of the past, or is it truly ready to thrive in the temperamental era?